Hello traders, today is the 10th of July 2013 and the time in London is 11 minutes past 6 p.m. In New York 11 minutes past 1 p.m. Happy trading to you all. The title of this video is Wave Trading Education Part 11. If you have not watched part 1 to part 10, you may do so before watching this part 11. All right, let's get started. In this video, we're going to focus on the ABCD, all right, chart pattern and wave trading. How can we use the ABCD chart pattern together with a wave analysis? Very, very powerful. All right. Now we know also that the Elliott wave cycle is formed of the motive waves and the corrective wave. All right, the corrective wave, we want to know the different type of correction that can take place. We can have a normal zigzag, a flat correction, a running flat correction. Also, we can have a triangle, the triangle that we call ABCDE. All right? Okay? So the motive wave plus the corrective phase, that's one Elliott wave cycle. When a cycle has ended, the market may start a new cycle, or it may start going up a bit, only to start a new correction. This is sometimes we see that with the double zigzag, ABC, X, ABC. So sometimes traders may see a correction like this. Okay, so all right, you see a correction like this, and they say this is the end of the correction, and then the price start going up. My apologies to trader, the price start going up like this. Now people see that this is a new cycle, but sometimes it's not a new cycle as such, but it's just an introductory wave, which we call the X, that really introduce another correction. So you may see like this ABC, and then we think that this is another cycle that has begun, and then this is just X, and then we see it again ABC, X, ABC. This is a triple zigzag. All right. Sometimes you may see also a double triangle, ABCDE, X, ABCDE. So you want to know the correction phase. This is what we are talking about. The market will not start a strong cycle if it is not supported by what? Fundamentals. We are talking about the macroeconomic conditions. We are talking about the individual financial instrument itself. We are talking about the market leaders. All right. We are talking about cycle points without a strong fundamental. Checking Google Finance, Yahoo Finance, the global economy. Talking about the economy in Japan, the economy in the United States, the economy in Europe, in Asia. This is about global market. The market is global. It's not one piece. All right. So you want to know where we are and what is taking place. All right. So let's move on to the ABCD, chart pattern and the wave counts. I'm going to bring on now the S&P 500, all right, very fast, and we can see that the S&P 500 has displayed ABC, and we are expecting a kind of D, okay, the point D. So let's move on back to this. If you don't know anything about the ABCD, okay, Alpha, okay, Bravo, Charlie, Delta chart pattern, ABCD chart pattern. If you do not know anything about it, you need to go to www.stochastic-macd.com. This is our website also. All right, but talking about Elliott wave trading, it's about 24elliottwave.com. All right, so I'm going to I'll leave my cycle point here, which we were discussed in the wave trading education part 10. If we start drawing lines on these charts for the S&P 500, we can see that the price was consolidating from this point. If I move this spotlight to the point here, you see that the price went down from here to here, but not in a straight line, but it went down into 1, 2, 3. Good. But when we are talking about the ABCD chart pattern, all right, what usually is taking place, ladies and gentlemen, pay attention carefully. During the A to B, all right, we can see 5 waves. The AB, A to B, is a motive wave. Now we can see that the B to C is a corrective wave. We will expect very often you'll see that the price will resume if there's a fundamental reasons, as I said to you, the price may start a new cycle, okay, after a completed correction, and then, okay, supported by strong fundamental, the price may start, okay, a new cycle. Not definitely, the price may start a new cycle, okay, to the point, okay, delta. The delta is a terminal zone when the bull are happy to take profit, and they will not interfere with the bear, and the bear will start selling. The bull will take profit, creating another bearish momentum that will generate a new correction. So very often, this is the pattern that we see all the time. All right. So the A, B, C, which is here, A, B, C. This is one Elliott wave cycle. So during the A to B, we may see 5 waves. It's an impulsive wave. All right. This is a bigger cycle. This is what's happening all the time. Now you know it. All right. This is what's happening all the time. And then we see a correction. Once the correction is completed, if the global economy is strong and the fundamentals are sound, a new cycle may begin. All right. And then we may form what we call a D. So from C, we are now looking at D. But it doesn't mean that the price will definitely reach that, okay? But this is just a target zone that we must be aware of. In theory, the distance from A to B should be equal to the distance from C to D. Sometimes, repeat, sometimes the distance from C to D can be longer than the distance from A to B, even sometimes shorter. The theory, traders should always separate the theory from the reality of the market. Everything is governed by a real value and a distortion. If a financial instrument is overbought or departed from its true value, there's a high chance that the price may return back to its true value, provided that the true value was not increasing at the same time where the price was rising. On the other hand, when a financial instrument departed from its true value by going down, okay, there's a high chance that it may rise up to its true value, provided that okay, its true value was not going down at the same time like the price. All right, very important, very, very important. Provided, repeat, provided. All right, very important. All right, because traders get sometimes confused with return to the mean. Return that to the mean does not mean that whenever there's a departure from the moving average, departure from the true value, the price will definitely return to its true value. If the true value is increasing at the same time like the price, there's a new true value that is in place. The price does not have to return to the previous true value. The point I want to make, talking about the A, B, C, D chart pattern, we are combining the wave cycle with okay, a chart pattern. The A to B is the motive wave. The B to C is the corrective okay, phase. The motive wave plus the corrective phase, that's a one Elliott wave cycle. So we may say from here all the way to here, this is one Elliott wave cycle. Now, before you get too excited about the ABCD, that now the S&P 500 will definitely reach this point, remember what I said at the beginning of this video. A correction can be a complex correction, which means we see A, B, C. Now, instead of having the price going straight away to D, we may see something like this. So we see what we call X. And then we may see again A, B, C. We may have another X again, A, B, C, before okay, a new cycle may finally begin. Now, get it right, because the problem that traders are facing, they think that okay, whenever we see the end of correction, this is the end of a correction. That's true, because the minimum price 1, 2, 3 change direction. Now it goes above, provided it goes above the previous high. Now it's above it. Good. If you return below it, now so far, because when we are counting the wave, we are going step by step. All right, so now it's above it, but the price can go below that key level again if you return back below it. So This is so when you are counting the way, you want to be very flexible. So it can go back below it, which means we're going to if you go back below it, so you may come back down, and then you say, oh, all right, 1, 2, 3, 4. So we say, oh, that's the A, B, C, D, E. All right. So don't you understand? All right. But in theory, we say that we do not see, okay, the A, B, C, D, E in the second wave. That's the theory. All right. That's the theory. So professional will be more willing to push it up. That's what I said to you. There's a high channel in 2016. We may see, okay, another cycle point, which I was discussing with you in the wave education, wave trading education, part 10. All right. This is a wave trading education, part 11, when we are now combining the A, B, C, D chart pattern with our wave analysis. All right. So we want to get things right. What is an Elliott wave cycle? Now, an Elliott wave cycle is formed of the multi-wave plus the corrective phase. But sometimes, when the corrective phase is completed, a new cycle will start straight away. But as I said to you, we must check the fundamental, very, very important, the global economy, and make sure that the market itself is about to begin a new cycle. Great. When the price starts going up, all right, very important, trader must not forget that one can have a complex correction, A, B, C, X, which means the price may go up a bit, pretending to start a new cycle, only to start a new correction again. So A, B, C, X, A, B, C, X, A, B, C. All right? No one knows when the correction will stop. All right? This is what I'm saying to you. Below everything, okay, at the start of every price move to the upside, there are fundamental reasons. For anytime you see the price going down, there are fundamental reasons why the price is going down. We must combine the technical with the fundamental. But if the fundamental are sound at the point C, C for Charlie, there's a high chance the price may start a new cycle. We know that the A to B is a multi-wave which is divided into 5 waves. 1, 2, 3, 4, 5. Now, after the corrective phase, which is the B to C, if the fundamental are sound and a new cycle has begun, we are likely to see another motive wave that is likely to achieve at least the length of the previous motive wave, which is the A to B. Why? Because that's why I said to you need to go to stochastic.com to know what is the ABCD chart pattern and how to understand it. The traders, the bullish traders that were buying this session know how much profit they have achieved. They do not forget it. As a new cycle has begun, they are thinking of how much profit they have made before. This is psychological, okay, trading. So they will say, we have achieved $100 in this profit. We want to achieve again $100 in this new cycle. Sometimes, if the momentum are very strong, if the fundamentals are very strong, the distance from C to D can be longer than the distance from A to B. But suppose at this point in time, the price start going up, but the macroeconomic conditions suddenly has deteriorated, all right? So we see maybe, for instance, more people being unemployed, okay? And the Fed start, printing money with other reasons, and people start thinking that the economy was not strong enough, so suddenly we see, okay, the price stopping, all right, somewhere here. So we'll say A, B, C, so we say this is X, so the price may start a new correction again. No one knows how far the correction will go. All we know is that we have at least 4 types of correction: the normal zigzag, the flat, the running flat, okay, and the triangle, all right? So you want to understand the phase, the different phase when you are using, okay, the Elliott wave. In the wave trading education part 10, we were talking about the importance of the cycle point. In this video, we are talking about the importance of the ABCD chart pattern going into the mind of other traders. We do not also want to forget, okay, we don't want to forget the complex corrections like a double zigzag, even a triple zigzag, or double, okay, a triangle, all right? The ABCD, in theory, the distance from A to B should be equal to the distance from C to D, but sometimes the C to D can be longer than the, okay, the distance from A to B. The A to B is a multi-wave which can be divided into 5 waves, and the C to D If it is a normal cycle, should be divided into 5 subway because it's an impulsive wave. But sometimes, in the case of a complex correction, which we see A, B, C, X, you may see something else where the price may not display a 5 wave. As always, traders must pay attention to the S&P 500 and understand, which point in the cycle are we at, You want to know the global economy, paying attention to the Japanese economy, paying attention to the American economy, and paying attention to the Europe economy, paying attention to the Asia economy, so that you do not use the Elliott wave, like a size. When the price reaches the point D, which is delta, after completing the ABCD, sometimes aggressive traders will place order here before the price will hit this point. So suppose the price was approaching, suppose the target zone is 3,000 here, and the price is already at 2,500. You will hear very often on Bloomberg, on major television, you see many analysts coming out and say to you that the Dow will go to 3,000, all right? During that time, aggressive trader will already place orders here to sell. Something else very often will take place. One market principle that I can discuss with traders today is that where there are orders, that's where the price will go. So if you have millions of orders packed here, the price has a high chance to fill these orders. The market is always talking about market makers. They want to fill orders. So as the price approaching the delta zone, which is the target zone, though the price now at, suppose the price now at 2,500, you will see many analysts barking on television and saying that the price will go to 3,000. In the meantime, some aggressive trader will place order here to sell. As the price approaching the target zone, you see these orders will be filled. Sometimes this can create a sharp correction. If, because as the price reaching the target zone, which is the terminal zone, the bulls that were buying are very cautious. They are aware of the target zone, the smart bulls. They are prepared to take profit. By taking profit, they must sell. As they are selling, plus the aggressive traders that are selling, that will increase the bearish momentum. Sometimes the price will gap down or create what we call a sharp correction. On the other hand, there is another group of traders that are what we call the dangerous traders, so to speak. All right, they see this order being packed here. They will take them out of their trade first, which means they probably go instead to 3,500 before coming back down. There is another group of traders that also will interfere with the ABCD chart pattern. That's why it's so important to separate the theory from the reality of the market and pay attention to the different type of market participants that are influencing the price. Fibonacci traders will use their Fibonacci projection tool to determine the Fibonacci extension zone, and they will say to you the price may go to 260 projection zone. Some may say to you the price may go to 314 projection zone. I hope you have learned something from this video about combining the ABCD chart pattern and the wave analysis. Looking at this S&P 500, if the fundamentals are sound, there's a high chance that we may see A, B, C, D chart pattern. The A to B will be a multi-wave, and another cycle may start as it is here, starting now. If the bullish momentum, we may reach the point delta. All right, until the next time, enjoy yourself and be very happy. We are the GSTWSYS 008 traders. This is about wave trading education, part 11, talking about ABCD chart pattern and a wave analysis.